Hi, this is Yashu Gupta, Senior Associate in the Investment Banking vertical of DPNC Advisors. Today we are talking about sectoral trends in late-stage private equity investing in India over the past 4 to 5 years with hard data, clear insights and implications for executives and investors alike. India's private equity and venture capital ecosystem has rebounded strongly since the pandemic trough. According to Bain & Company India's private equity report, total PVC investments in India reached approximately $43 billion in 2024, up about 9% year-on-year after 2 years of decline. Buyouts accounted for roughly 51% of total PE deal value, with funds increasingly acquiring high-quality assets at scale. In the first half of 2025, private equity and VC deal value was around $26 billion across 593 deals, with infrastructure, financial services and technology emerging as the top sectors. These figures signal depth and resilience in the Indian private capital ecosystem. Let's start with the technology sector. Technology has been a central magnet for late-stage capital. In 2024, consumer tech attracted nearly $6 billion in scale-stage investments driven by firms like Zepto, Meesho and Rapido. In the first quarter of 2025, the tech sector accounted for roughly $3 billion in investments, the top sector in value in that period. These numbers demonstrate late-stage investors continue to bet on digital platforms with strong unit economics and path to profitability, moving beyond just pure narrative growth. Moving on to financial services, in the first quarter of 2025, financial service investments reached approximately $1.6 billion, up modestly from the prior year. Financial services was the leading sector in October 2025, reaching about $3 billion in PVC investments, more than half of all inflows in that month. This trend reflects investor confidence in regulated assets, embedded fintech distribution, and scalable lending platforms within India's fastest growing financial ecosystem. Moving on to healthcare, its story is more nuanced. Total PVC investment in healthcare fell to about $1.5 billion in 2024, which is the lowest since 2020, highlighting sectoral cyclicality. Yet, healthcare still accumulated $14.5 billion in investments since 2020, with 58% of that deployed in 23 and 24, driven by hospitals and health tech. This suggests that while investments can fluctuate year to year, healthcare remains a strategic late-stage target due to demographic tailwinds and capacity expansion needs. Two broader themes have shaped late-stage private equity allocation. The first one is investors increasingly prioritizing businesses with clear cash flows, scalable models, and exit visibility over sheer expansion. And secondly, infrastructure and industrial platforms have grown their share of capital, reflecting India's pivot towards manufacturing competitiveness and long-cycle assets, especially visible in the first half of 2025, where infrastructure led investment value. Now I'll talk about the most important piece in PVC deals, which is the exits. In 2025, PVC exits reached $18 billion. The contribution of strategic sales in total exits have been increasing year on year. In 2025, they accounted for nearly 30% of exit value, up from 20% last year. However, the contribution of public market exits via OFS component in IPOs and block deals have reduced from 68% in 2024 to 62% in 2025. Per Bain's private equity report, one of the most important reasons for this decline in exit value in CY25 is investors' entry at high valuation. Investors that have entered at significantly higher valuation in late-stage rounds are not able to realize their expected returns via public markets or secondaries. To sum up, late-stage private equity in India is maturing from growth at any cost to quality-oriented cash flow and resilient investing. Technology, financial services, and infrastructure dominate capital deployment. Healthcare remains strategic, though investment rhythms vary year from year. Exit liquidity and disciplined valuation are now core to late-stage investing decisions. This structural evolution reflects greater sophistication, selective capital allocation, and investor discipline, which are hallmarks of a maturing private market ecosystem. Thank you very much.